this section, we're going to cover stock dividends and stock redemptions. Under Section 305A, a stock dividend usually isn't taxable unless it changes the shareholders' proportionate ownership of the company. So if you think about this, this makes sense because if I own 10% of the company and the company issues a stock dividend, so everyone who has one share now has two, they give everyone an additional share for each share they own. I still own 10% of the company, and no one has put any money in the company, and my rights to share in the profits of the company are still limited to my 10% ownership. So nothing has really changed. So that is not a taxable event. It might be taxable when these 305B circumstances come into play. So the first, if the shareholder can elect to receive cash or stock, if some shareholders receive property while others increase their proportionate interest in the corporation's assets or earnings and profits, if some receive preferred stock and some receive common stock, if the underlying stock is preferred, unless the distribution involves a change in the conversion ratio of convertible preferred stock to take into account a common stock dividend or a common stock split, or the distributed stock is convertible preferred, unless it can be established that the distribution will have no disproportionate effect. So the basic premise of all of those things I just read to you in 305B is that it's changing either how much the relationship of ownership in the company, so shareholders are either increasing or decreasing their amount of ownership, or is changing the rights of a shareholder. So if we have a non-taxable stock dividend, we treat it like this. The basis of the stock is reallocated between old and new shares. So the basis I had in my original 10 shares will just be reallocated over my 20 now. If the new shares and the old shares are identical, the basis is going to be split based on the number of shares. And if they're not identical, it's going to be split based on relative fair market values on the date of distribution. The holding period for the new shares is going to include the holding period for the old shares, and no gain or loss will be recognized by the issuing corporation and no effect on earnings and profits. If I receive non-taxable stock rights instead of shares, so rights are the right to purchase stock in the future. So if I receive non-taxable stock rights, Section 305A says they're generally not taxable unless, again, they change the proportionate ownership of the company. And Section 305B, the same exceptions apply. So same thing, except now we're talking about rights. In the case of non-taxable stock rights, if the value of the stock rights is less than 15% of the value of the stock with respect to which the rights were distributed, the basis of the rights is zero, unless I would choose to allocate basis to the rights. So I can have a zero basis. I could choose to allocate basis to the rights, and I might want to do that if I'm going to sell the rights, because I might want to recognize a smaller gain. So a higher basis is going to mean a smaller gain, but I don't have to allocate basis to those rights. If the taxpayer does intend to sell the rights, this is what I just said. If the taxpayer intends to sell the rights, they could allocate some basis to that to minimize the gain. The holding period for rights includes the holding period for stock. And if the value is greater than 15% of stock with respect to which the rights were distributed, I must allocate. And just like before, there's no gain or loss recognized by the issuing corporation and no change to earnings and profits. All right, if the stock dividend or stock right is taxable, we treat it like we did any other property distribution. So if it's a dividend, we do the same thing, right? We recognize the dividend amount as the fair market value, and it's a dividend to the extent of earnings and profits. The recipient takes a fair market value in the stock or the rights. The holding period for the stock or rights begins on the day after the distribution date, and the distributing corporation recognizes no gain or loss on the distribution. The corporation would reduce its earnings and profits by the fair market value of the stock or rights on the distribution date. So none of this should surprise you because it's exactly the same treatment as a property distribution. Wilton Corporation has a single class of common stock outstanding. Robert owns 100 shares, which he purchased 6 years ago for $100,000. In the current year, when the stock is worth $1,200 per share, Wilton declares a 10% dividend payable in common stock. On December 10th of the current year, Robert receives 10 additional shares. On January 30th of the subsequent year, he sells 5 of them for $7,000. A. How much income must Robert recognize when he receives the stock dividend? So this appears to be just a non-taxable stock dividend. He owns 100 shares, and it says that Wilton declares a 10% dividend payable in common stock. There's no indication that shareholders had a choice of property or stock. There's no indication any ownership percentage changed as a result of this dividend. So Part A, this is just a non-taxable stock dividend, so Robert will recognize no gain under Section 305A. All right, Part B, how much gain or loss must Robert recognize when he sells the common stock? So now he's selling the common stock to somebody else. And on December 10th, he got 10 shares. On January 30th, he sold 5 of the shares for $7,000 total. So to know what his gain or loss is, what do we have to know? Well, we have to know amount realized, which we do, $7,000, and we have to know his adjusted basis. In a non-taxable stock dividend, remember we calculate adjusted basis by allocating the basis of the shares he already owned over the total number of shares he owns. So, let's see here. He purchased the shares 6 years ago for $100,000. So he purchased 100 shares for $100,000. Since this was a non-taxable stock dividend, we have to divide that $100,000 of basis now over 110 shares because it was a 10% dividend payable. So 100 times 10% is 10. So I'm going to divide $100,000 divided by 110 shares. So my basis is $909.09 a share. He sold 5 shares for $7,000. So amount received is $7,000 minus the adjusted basis of $4,545.45. There is a recognized gain of $24.54.55. And Part C. What's Robert's basis in his remaining common shares? When does his holding period in the new common shares begin? Okay, so let's answer the basis question first. No, let's answer the holding period question first. So we know that in a non-taxable stock dividend, the holding period continues on. So the holding period in the new shares is the same as the holding period in the old shares. So that started whenever he bought those first 100 shares. Now, Robert's basis in the remaining shares is going to be $100,000 minus the basis in the shares he sold. So in Part B, we calculated that. He sold 5 shares. The basis was 45, 45, 45. So the basis remaining is $100,000 minus that number. Stock redemptions is our next topic. That's when a corporate goes out and buys its own stock. So before in accounting, you call this treasury stock, right? They went out on the open market and they acquired shares for the treasury. So this can have a different effect depending on if this looks more like a dividend or it looks more like a sale. And the shareholder is going to have some tax questions and the corporation is going to have some tax questions. On the shareholder side, we want to know the amount of the income, gain or loss recognized, and as a result of the redemption and the character of that income, gain, or loss. We want to know the basis the shareholder takes in any property received in exchange for his or her stock. We want to know the holding period for the distributed property and the basis. What basis does the shareholder take in any distributing corporation stock held after the redemption? On the corporation side, we want to know the amount and character of gain or loss, if any, that the corporation has to recognize on the redemption. And we want to know the effect the redemption has on the corporation's earnings and profits. All right, so on the shareholder side, the tax consequences, like I said, depend on whether the transaction looks more like a dividend or a sale. So it's going to be treated as a sale if one of these conditions apply. The redemption is substantially disproportionate. The redemption is a complete termination of the shareholder's interest. The redemption is not essentially equivalent to a dividend. The redemption involves a partial liquidation of the corporation in conjunction with its redeeming stock from a non-corporate shareholder, and the redemption provides funds for an asset to pay death taxes. And we're going to go through these in later slides, but you can kind of see that the goal of these tests is to identify redemptions that truly mark a change in ownership. So either a dramatically smaller amount of ownership or a complete relinquishment of ownership, something like that. If the redemption is treated as a sale, the gain or loss is the fair market value minus the adjusted basis, and the character of that is going to depend on the character of the stock redeemed. So this is just, we learned this back in individual income tax, right? If I sell something, I measure the gain or loss as what I received, which what I receive is the fair market value minus adjusted basis. And then the character of that depends on the kind of property that I sold. So here it was stock. And so the character of that stock is going to depend on what type of property it was in my hands. Was it a capital asset or an ordinary asset? The basis of the asset received in the redemption is the fair market value, and the holding period is going to begin the day after the date of redemption. If it's not treated as a sale, it's going to be treated as a dividend. And if it's treated as a dividend, it's treated just like we've talked about everything else in this chapter. The shareholder's basis in the shares redeemed is reallocated to the shares still owned. All right, so if you look back at these 5 circumstances where this redemption will be treated as a sale, you can see a lot of them deal with ownership. Right? Complete termination of my interest, substantially disproportionate. It is going to focus on how much of the shares I owned before and after the redemption. So when we talk about ownership, these attribution rules are going to apply. So I'm going to be treated as owning stock I own actually, and also stock owned indirectly and by attribution rules through relationships. All right, these are kind of similar to the Section 267 attribution rules or constructive ownership rules, but there are some differences. All right, so for Section 318, these rules are going to apply to determine ownership for the purposes of sale versus dividend treatment. We have family attribution. An individual is going to be treated as owning all stock owned by his or her spouse, children, grandchildren, and parents. An individual is not considered to own stock owned by his or her brothers, sisters, or grandparents. Okay, so this is a little different than Section 267. It doesn't apply to brothers and sisters. It's just parents and then children and grandchildren and spouse, of course. So that's the family attribution. We also have entity attribution. Stock owned by or for a partnership is considered to be owned proportionally by the partners. I own 20% of partnership AB. If partnership AB owns 100 shares in something, I'm treated as owning 20. Stock owned by or for an estate is considered to be owned proportionally by the beneficiaries. All right, same deal as the partnership. Stock owned by or for a trust is considered to be owned by the beneficiaries in proportion to their interests. Same concept. Stock owned by or for a C corporation is considered to be owned proportionally only by shareholders owning, directly or indirectly, 50% or more of the corporation's stock value. So this one's a little bit different. If I own 40% of corporation ABC, and corporation ABC owns 100 shares of something else, I'm not attributed any of that ownership because I only own 40% of that corporation. If I own 51% of that corporation, I am attributed 51% of the shares that corporation ABC owns. All right, and so also attribution to entities. So we had attribution from entities and attribution to entities. Now, one thing I want to touch on is that I can use each rule once. So if my spouse was attributed to own property from his parents or stock from his parents, that is a family attribution. So his parents own shares of Home Depot. My husband is attributed those shares of Home Depot. My husband can't then attribute those to me That would be the use of family attribution rules twice. However, if my husband is attributed shares of Home Depot from his parents, my husband can then attribute those shares to a corporation in which he owns 100% of the stock. Because he used a different rule, he used the entity rule. So he used family one way and entity again. I can use each rule one time, not twice. All right, so we did family and we did attribution from entities. Now we're going to do attribution to entities. All stock owned by or for a partner is considered to be constructively owned by the partnership. All stock owned by or for a beneficiary of an estate or trust is considered to be constructively owned by the estate or trust. All stock owned by or for a shareholder who owns directly or indirectly 50% or more of a C Corp's value is considered to be constructively owned by the corporation. So like I said, we're not going to reattribute from entity to another partner, beneficiary, or shareholder. And a person owning an option to purchase stock is treated as already owning that stock for these purposes. So to meet the substantially disproportionate test. So now we're going through the test. Remember on this slide, I said a redemption is treated as a sale if one of these tests apply. So now we're going to go through each test. The first test is substantially disproportionate redemptions. So to meet this test, all of the following, these three things must be met. After the redemption, the shareholder owns less than 50% of the total combined voting power of all classes of voting stock, and after the redemption, the shareholder owns less than 80% of his or her percentage ownership of voting stock before the redemption. And after the redemption, the shareholder owns less than 80% of his or her percentage ownership of common stock, whether voting or non-voting, before the redemption. Okay, so all three have to be met. We're trying to get to a place where a redemption represents a meaningful reduction in ownership. So I have to own less than 50% of the corporation, and I have to own less than 80% of my percentage ownership before the redemption, both in voting stock and all stock. Another way that I could treat this as a sale is a complete termination of shareholders' interest. So if I completely sell everything off, family attribution rules can be waived if all the following apply. So I've sold everything, but remember, attribution would make me own something, or not own it, but would make me constructively own something I don't actually own. So if I'm trying to totally sell out of all my interest and treat this as a redemption, I completely terminate my entire interest. Family attribution rules can be waived if all of the following apply. After the redemption, the shareholder must not retain any interest in the corporation except as a creditor, that they cannot serve as an officer, director, or employee. The shareholder must not acquire any interest for at least 10 years from the date of redemption, and the shareholder must file a written agreement with the IRS that he or she will notify the IRS upon acquiring any prohibited interest. All right, redemption is not essentially equivalent to a dividend. This is a much it's a more wishy-washy standard, right? It's a facts and circumstances inquiry. So that means there's no hard and fast rule. It means the IRS looks at the circumstances of the transaction and they see if this redemption is not essentially equivalent to a dividend. It doesn't look like a dividend, it looks like a sale. So there's no guidance in the code and there's no guidance in the regulations. But there is a court case, that gave us some guidance. It said that a business purpose for the redemption is irrelevant for this test. The Section 318 attribution rules must be applied to establish dividend equivalency, and a redemption of part of a shareholder's stock is always essentially equivalent to a dividend. A redemption of part of a sole shareholder's stock. So if I own all the shares of a corporation, any redemption is going to be a dividend. Which that makes sense because no matter how much you redeem, I'm still going to own 100%. All right, and partial liquidations are not dividends. A partial liquidation determination is going to be made at the corporate level, and it must result in an actual contraction of the corporation's business. I must sell off a division. I must cut the workforce. I must cut the budget, something like that. Here there's a safe harbor, a Section 302E2 safe harbor. A safe harbor means if I do these things, the IRS has already blessed this transaction. If I do these things, it is a partial liquidation. The distribution is attributable to the distributing corporation ceasing to conduct a qualified trade or business or consist of the assets of a qualified trade or business, and immediately after the distribution, the distributing corporation is engaged in the active conduct of at least one qualified trade or business. All right, and they define a qualified trade or business as a trade or business that has been actively conducted throughout the 5-year period ending on the date of the redemption and was not acquired by the corporation within such 5-year period in a partially or wholly taxable transaction. All right, so we are ceasing to conduct a qualified trade or business, but we still conduct another qualified trade or business. So we are contracting, but we are not going out of business. That's basically what the safe harbor says. A distribution qualifying as a partial liquidation is treated as a sale of stock for a non-corporate shareholder. And in the case of a corporate shareholder, the same transaction is treated as a dividend unless the transaction qualifies for sale treatment under one of the other 302B tests we've been talking through. And then dividend treatment may be preferred by the corporate shareholder because, remember, corporate shareholders receive the dividends received deduction. And that should say 50%, 65%, and 100%. And we have Moose Corporation's 400 shares of outstanding stock, and they're owned as follows. We want to know how many shares Laura is deemed to own under 318. Okay, so she obviously owns the ones that she owns directly. How about LMN Partnership? She is a 20% partner. So she is going to be treated as owning 20% of those 50 shares. All right, so 10 shares there. She is also a partner in LST Partnership. She's going to be treated as owning, because she is a 70% partner, she's going to be treated as owning 70% of those 100 shares, so 70. Lemon Corporation. She is a 30% shareholder. So remember, for our rule, our purposes, she's not going to be attributed any of that because she has to own at least 50% of a corporation. All right, and Lime Corporation, she is a 60% shareholder. So she is going to be attributed 60% of those 90 shares, so 54 shares. So of the 400 shares of Moose Corporation, she is going to be deemed to own 194. Again, that's her 60 shares directly, 10 shares through the partnership, 70 shares through the other partnership, and then 54 shares through Lime Corporation. Paul owns all 100 shares of Presto Corporation stock. His basis in the stock is $10,000. Presto has $100,000 of earnings and profits. Presto redeems 25 of Paul's shares for $30,000. What are the tax consequences of the redemption to Paul and to Presto? Okay, so Paul is the sole shareholder. We know that the rules say that any redemptions for a sole shareholder are going to be treated as dividends. So this is going to be treated as a dividend because after this redemption, after they buy 25 shares, right, he had 100 shares. They're buying 25. He now has 75, but there are only 75 outstanding. So he still owns 100% of the corporation. So this is a dividend. They paid $30,000 for those shares. So the dividend is going to be valued at $30,000. He's going to have $30,000 of dividend income. His basis in the stock is $10,000. It's going to still be $10,000. So, like we said, because Paul still owns 100% of Presto's stock, the redemption is treated as a dividend. He has a $30,000 dividend. His $2,500 basis in the redeemed shares is going to be added to his $7,500 basis in his remaining shares. So his basis is still $10,000 in 75 shares now. And Presto's earnings and profits is reduced by the amount of the dividend, which is $30,000. Okay, now let's look at the distributing corporation's tax consequences in a redemption. The corporation will recognize gain when it distributes appreciated property in redemption of its stock, as if it had sold the property immediately before the redemption. And this is whether or not it's treated as a dividend or a sale. The character of the gain depends on the character of the distributed property, and the corporation does not recognize any loss realized when it distributes property that has declined in value. Looking at earnings and profits, if appreciated property is distributed, the gain is included in earnings and profits, which we know this. If the redemption is treated as a dividend by the shareholder, the corporation will reduce earnings and profits by the amount of the dividend. So that could be the amount of money, the principal amount of any obligation, or the fair market value of any other property. But just like we have been doing this whole chapter, we reduce earnings and profits by the amount of the dividend. If, however, the redemption qualifies as a sale, current and accumulated earnings and profits balances are reduced by the portion of earnings and profits attributable to the redeemed stock, but not by more than the actual redemption distribution amount. The remainder of the distribution reduces the corporation's paid-in capital account. All right, so White Corporation has 100 shares of stock outstanding. Ann owns 40 of those shares, and unrelated individuals own the remaining shares. White redeems 30 of Ann's shares for $30,000. In the year of redemption, White has $30,000 of paid-in capital and $80,000 of earnings and profits. How does this redemption affect White's earnings and profits balance if the redemption qualifies for sale treatment? So if it qualifies for sale treatment, remember we're reducing earnings and profits by the amount attributable to the shares that are redeemed. So White is redeeming 30 shares out of 100 total shares. So 30% of the shares. So we're going to reduce earnings and profits by 30%. Earnings and profits was $80,000. So I'm going to reduce it by $24,000. All right, and then I made a $30,000 distribution. So the remaining $6,000 of that distribution is going to reduce the balance in the capital account. B, how does the redemption affect White's earnings and profits balance if the redemption does not qualify for sale treatment? So if it is not a sale, it is a dividend. If it is a dividend, we reduce earnings and profits by the entire amount of the dividend. So $30,000 reduction.